Hello and good morning, everyone. To XM Live, the Advanced Room second hour, and it's London opening. And I would like especially also to welcome the viewer that are watching us on YouTube this morning. We are under we and you and me. We met already yesterday. We are after a historical week. There is definitely less action this week, even though we got yesterday maybe a little bit of surprise of Bank of Japan. We got this morning a little bit surprising data from England, and we see the pound is moving a lot. And I must say, in general, there is wonderful trends out there. There is really wonderful trends out there. And I would say, even though that normally you call like this liquidity going down through Christmas and everything, in the last couple of years, I must say, trading is actually quite good during Christmas and New Year.
Yeah, good morning, Gil. Good morning, viewers from YouTube, from XM Life Education. Good point about the last week FOMC. I just give you example of gold move, $50 on a FOMC news. And right now it's in consolidation. As you see, it's clearly that's the meeting was 13th of December. Right now it's 20th of December, exactly 1 week ago we got a meeting. So you see that consolidation is after the actual move on gold happened, right? Does it change the game for the long run? Does gold going to go up or down from here? That's to see. But we were talking about what have changed last week, and what had changed was the statement and more dovish Fed statement about the possible pivot on yields from Powell. Powell said that actually that we might have seen already the top of the rates, or we're close to it, and we are close to the probably close to the end of the tightening cycle. So immediate reaction was gold up, weaker dollar, and that was kind of a game changer. And when you look at the bigger picture, bond yields, I have here like 20 years. Let me see. Bond yields, United States, somewhere here. Yeah, going back into 90s. Going back into 90s, right? The upper chart is the bond yields, United States. And you see that they went into 5%. That was the case back in 2007 that we got those levels, right? And now the main idea, I think, after we got a statement, after we see inflation going down, is that those bond yields will be going down back into normal level. And normal level, I would say maybe 3%, right? And this is kind of a long-term picture that I'm looking at, that those bond yields in the United States, that will go down. And the orange chart, you have the US dollar, Japanese yen. And we are just past the Bank of Japan decision yesterday. We were talking with Gil, remember? And the idea is that actually Bank of Japan wouldn't be dovish anymore. It might be only hawkish or being neutral, being sitting on where it is, right? So knowing that and looking at the bond yields United States and possibility of the Bank of Japan getting more hawkish, normalizing its policy, idea is that US dollar Japanese yen is almost a cinch to sell and look for the declining US dollar Japanese yen here, together with the macro situation, and together with those monetary policies of Bank of Japan and United States, which are diverging right now. So that was the main point in a fast recap of FOMC and Bank of Japan yesterday.
Look, my main idea is very, very clear for the next couple of weeks. Because of the dovish Fed, I think the dollar will get weaker. Now, I'm not so convinced about all currencies if they get all much, much stronger. But in general, I think we will have and I'm also not so much convinced about the stock market. And Prajwal, I see you here this morning. Fantastic to see you. I think I didn't see you for a couple of days at least, maybe even week. I'm not convinced about the stock. So the stock market is rallying like crazy also since the event. But in midterm, I'm not convinced about the stock market. The stock market is pricey. I also believe that yields a little bit over-exaggerated, so they came down a little bit too fast. And I agree with you, they can come back into 3.0, but not that fast. Here is something that is really, that I thought about it the last couple of days. You know, the ECB actually was right. Right? The ECB in 2022, they were saying inflation is transitory and we will not raise interest rates. The Fed started to raise interest rates. The ECB did not. And then the ECB got convinced by the Fed and other central bank, no, inflation is not transitory, it's sticky. So they changed their monetary policy. And now it seems like, you know what? They were right. Inflation was transitory because the stock market in the US or the market economy in the US is still strong and inflation is coming back. How is this possible? All economical models say that's unreal. And the only explanation is that inflation was just transitory. So they were actually right. Now, here is the funny thing. The Fed starts to realize that they were right and they're ready to lower interest rates, even though the economy is still doing very good. Now, the Fed changed camp and they say, no, inflation is much more dangerous and it's much more sticky than that we thought. And they stick now to the new narrative. And again, you know what? Maybe they're right now again. Maybe we will see higher inflation the next couple of months.
So it looks like the inflation reading bluffed all central banks, and it is doing that
Yes.
again, right? Yeah, so this is to be seen. But you can see exactly that the other central banks were following the Fed with the judgment, right? When the Fed judged that inflation is
Yes.
transient, that all central banks repeated the mantra, look, inflation is transient. But then when Fed started to raise rates, they just waited and say, you know what, we should do the same.
Exactly.
Now, as Fed lowering rates, we see other central banks also kind of a lowering.
They will follow.
They will follow. What does it mean
And
for
it
dollar?
doesn't mean if they're, and I will say why I believe that actually inflation will go up the next couple of months. I look at different parameters on inflation every month. So I look at the job market and average hour earnings. That looks good. Then I look, of course, at CPI and the different sectors which are coming down. We have still the service sector that is very sticky and doesn't really come down. That's a problem that inflation continues to go down. We see commodities. Now, commodities, they came down very strongly. So that's actually good. Oil prices are cheaper, but now they're raising again. And I want to point out one event that is important now. Nobody really talks about this a lot, but there are the Houthis in Yemen, and they are financed by Iran, and they don't allow any ship to go into the Red Sea. They're afraid those ships. The Houthis, they announced war against Israel because of the war in the Gaza Strip, and they don't allow anyone to go into the Red Sea. Now, the ships have to go into the Red Sea because they need to pass Suez Canal if they want to go to Europe. Now, all the ships in the last 2-3 weeks got attacked, and some severe, and some got kidnapped. So now the ships have to go around Africa in order to go to Europe, and that adding for every shipment, adding about $1 million. So cargo becomes more expensive. And this is the supply chain that we had in 2021, this problem. So it seems like this is rising again. And I think inflation actually will rise the next couple of months. So I think the moves that we saw are now a little bit overdone. So the dollar came down a little bit too fast. I still think in the long run the dollar will go down, but at the moment I think the dollar came down too fast, yields came down too fast, and stock market went up too high. And I think we might see in the beginning of January a reversal here.
All right, so maybe the road that I'm showing here back into the yields, which is more normal environment, will be 2.5, but taking into account what Gil said, maybe there will be more bumpy. So actually
Exactly.
that will mean that, okay, still the rates, short-term rates wouldn't go down so fast. You'll have a bump in those 10-year bond yields. At the moment, they're at 3.9. Maybe they go 3.7, they bounce into 4.25, depends on the trajectory of inflation. And US dollar, Japanese yen, which correlates very closely to that one, might also have those bigger rallies to the upside. Eventually, I would say that the bond yields will go probably into 3%. This was just kind of a normal situation. Let's say recession of the year 2000, dot-com boom and bust. You come out of the recession, you come with a lower rates that you had before the recession. The recession crisis 2008, 2009. You come out in the normal environment 2010, 2015 with the levels lower than you got before the recession. The problem 2020 is that you went into zero rates, and when you come out of that, you got this transient inflation, supposedly to be transient inflation, and it was staying there for some time. That's why those bond yields went up to 5%. But right now we're going back to normal probably, and I would say the long term, I expect those be at around 3%, and at the moment
Yes.
3.9. So eventually, US dollar Japanese yen is destined to go lower.
Yes.
But what Gil says, that's it's not the easy road because of those Houthis, because of other things, and we might have those bigger rallies on bond yields, and together with it, bigger rallies on the US dollar Japanese yen, and also rallies on dollar strength. So dollars might be rallying, dollar might be rallying also together with those inflation readings. And in the meantime, inflation reading in other countries coming down. Look, today we got the UK
Yeah, it's
inflation
good.
significantly lower
Yes.
compared to the recent reading. Look at this. So what do you said about the potential threats? Inflation, is it global? Probably yes, right? If we're talking about
Yes.
the Red Sea and supply channels, that means that inflation UK wouldn't have an easy road as well to the downside. That will be
And I just want to add, the ECB just said in the previous week, they are expecting an inflation goes up the next couple of months. Their forecast by the economist of the ECB is saying inflation will go up in the first couple of months. And this is why they're still not discussing rate cuts. And maybe they're right. Maybe the Fed was a little bit too dovish here. By the way, it's absolutely not understandable why they were so dovish. There was no reason to be that dovish. And it's like they're a little bit hyped. The Fed in this, they were too optimistic, I think. And I think actually the ECB here might be right. Now, I see a questions from Prajwal, and Prajwal is asking about the COT report about the stock market. Now, look, Prajwal, the COT report this week is problematic. Why is it problematic? The numbers that we are having, they are from last Tuesday. So that means the numbers that we are having from the COT report is before the Fed meeting, before the ECB meeting, before the Bank of England meeting, and before the big expiry day on Friday. So I think the data from the COT report this week has to be taken extremely cautious. And I think I'm waiting for next week data that can give me much a clearer picture where the market is heading. Based on the COT report, I would say actually that the Nasdaq is not very bullish. Opposite, I think the Nasdaq is overdone, but you see again, after the extremely dovish Fed meeting, it just goes up like crazy. Based on the COT report, actually, the Dow looks still very bullish. So Dow bullish, Nasdaq bearish, but again, take this with caution because it's before all the events that we had in the previous week.
And I'm showing you also PC core PC reading of which we're gonna have on Friday.
Yes.
Just before the US session starts. and trajectory right now is to the downside. And the Fed supposedly in their recent projection to lower rates into 4.6% the following year, the 2024 rates, so Fed rate.
Mm-hmm.